Hello friends, how are you? So I hope you all are doing great, fit and fine, right? Enjoying the lectures. Yes sir, we are enjoying our studies, we are enjoying our lectures and studies are going quite good sir. Okay, so we are continuing with our material costing discussion, and in this discussion the next topic that we have is purchase price valuation. Very easy topic, a small topic, and it can be asked in the examination maximum for 5 marks, right? Not more than 5 marks. So a 5 marks question can be expected. We can expect a 5 marks question from this topic, that is purchase price valuation, right? So what does it mean, sir? Purchase price valuation, purchase price of what? Purchase price of the raw material, purchase price of raw material. Sir, why it is important to value this? What is the need for this valuation, sir? Because whatever is the cost of raw material that we are using in the manufacturing of finished good, we have to recover that cost from our customer, isn't it? Obviously, sir, whatever cost you are incurring in this raw material, this cost you will recover from your customer when you will sell your finished goods. So if this cost, if this valuation is wrong, that means you will not be able to recover this cost and you will sell at incorrect prices. So it is important to value the raw material, that is whatever we are buying, the raw material that we are buying, what is the cost that we should record in our books, what is the actual cost that is going out of our pocket. Okay, so let's see what all is included in this. The first thing is the invoice price or the list price, right sir? The invoice or the list price, obviously when you will buy something, you will receive the invoice, right? You will receive the invoice, sir. That means the list price means the taxable value, we can say. Less if there is any trade discount, including the quantity discount. Okay, sir. Right? Less if you are going to get any subsidy. Okay, we'll subtract it. Why we subtract this, sir? This is basically a gain for us. Right? This is not a cost for us. This is a gain, or I can say this is a benefit for us. That is why we are going to subtract it. Right? Then we get the net invoice price. We can also call it as taxable value. Right? Like in the GST, we have the concept of taxable value. This can also be known as taxable value. This we can say as net taxable value after the discounts and any subsidy. Right? If any subsidy is receivable from the government, this will reduce our cost. That is why we are subtracting it. If there is any discount, it is again going to reduce our cost. That is why we are subtracting it. Now, the additions, import duty or the customs duty, any duty, right? Packing charges or the cost of containers, loading and unloading charges, transit insurance, right? Then carriage or freight inwards, not outwards. Outwards is on the sale of goods. Inward is on the purchase of goods. Add commission or brokerage payable, add IGST, SGST, CGST only if credit is not available. Now this is important, I'll explain you this, right? Less the realizable value of packages and empties. Sir, what does it mean, the realizable value of packages and empties? Say you have a confectionery store, right? You sell bread, every one of us know, right? You have a confectionery store and you sell breads. The bread comes from the manufacturer in containers or in trays, right? Each tray containing 12 or 24 or 50 breads like this. Okay, now what happens, the manufacturer will give you the breads in that container and later on you will return that container. When you return that container, the price of that container will be reduced, right? If you keep that container, obviously, sir, for the manufacturer, that container is also a cost. If you keep that container, he will charge you. If you return that container, he will not charge you. Clear? Purchase price, this becomes the purchase price to be recorded in the books. Clear? Now, what is important point here to note is, sir, any cost from the time you place an order till the material is received in your store, all that cost will become the part of your purchase price, right? So you can write it down, a note here. You have to write it down. Even if you have the handbooks, this topic is not there in the handbooks. You have to write down this topic. You can pause the video, you can write it down, right? You can pause the video here and write it down. Write down the note here. Note says any cost incurred from the time of placing order, from the time of placing an order till the time the raw material is received in your store, raw material is received in your store, right, will be part of purchase price, right? That is why we include this carriage and freight inwards, we include this transit insurance, we include this loading and unloading charges. So any cost from the time you place an order with a supplier till the time the raw material is received in your factory, any cost incurred in between this will become the part of your purchase price, and you will recover this from your customer. But sir, but what? But there can be some cost which will not form the part of the purchase price. Sir, which cost? Let's see the important points to remember in this regard. Cash discount will not be reduced, right? Sir, penalty or demurrage charges will not be added in the purchase cost. Why, sir? These two expenses, why these will not be considered? Sir, because these are purely financial expenses. These are purely financial charges or benefits, right? It has nothing to do with the cost. These are purely financial matters. Penalty, sir, if you are paying a penalty for something, will you recover this penalty from your customer to whom you will be selling the finished good? No, sir. Paying penalty, that means you have committed the mistake. If you have committed the mistake, for that mistake you cannot charge from the customer. Clear? Units of normal loss of material will be reduced and the cost of remaining inventory will be inflated. We'll do the practical problem and this point will be clear. If there is a normal loss, right? What is a normal loss, sir? Normal loss is which is unavoidable, which normally happens, which is a routine thing, right? Abnormal loss is due to some uncertain event, due to some flood, due to some accident, due to something else. That is abnormal. That is not for the normal reasons. That is for some uncertain event that was not expected. So abnormal loss of material will be charged to costing, profit and loss account. Duties on which ITC is available are not to be added. Now this is very important point. Sir, you will be studying the GST, or some of you might have started studying the GST. What will happen in the GST? Sir, say the taxable value of the goods is, say 10,000 rupees, right? On that you are charging the IGST at the rate of say 18%, right? 1800 is the IGST. What is the total bill amount? That is 11,800. Now, when this bill will come to you, you will take this IGST as input tax credit. Obviously, sir. So this will reduce your liability of tax. 1800. Sir, very simple. You will pay this 1800 to the supplier, right? Obviously, sir, the supplier has to deposit with the government. You will pay this 1800 to the supplier. That means the 1800 will flow out of your pocket. But at the same time, you will take this 1800 from the government in the form of ITC, in the form of input tax credit. That means from one pocket, 1800 will go out and it will come in the other pocket. Right? So will it affect any cost, sir? 1800 flowing out of the pocket and 1800 coming into the pocket at the same time. So should it be included in the cost? Should it be included in the cost? No, sir, it is not a cost, right? You will be paying 1800 as tax to the supplier, but at the same time you will be taking 1800 from the government in the form of input tax credit, that I have paid tax, give me the credit for this, give me the credit, give my 1800 back. So this is input tax credit, and in such cases this is not my cost, it is any duty on which ITC is available. See, one thing you have to remember, on every duty the ITC is not available, right? On custom duty, not available. On octroi, not available, right? So you need to be very careful that on which duties the ITC is available. Sir, what about in the practical questions? In the practical questions, most of the times, 99% of the times, you will be given in the questions, that the ITC is available against this duty or not, right? Or what you can do is you can make a reasonable assumption. You can make a reasonable assumption. Sir, we are not taking this duty, we are not taking the GST on the consideration that the input tax credit is available against this GST, right? So this can be one assumption that you can make in the examination. Clear? So write down this also. Important points to remember regarding this. Cash discount, not to be taken. Penalty demurrage charges, not to be taken. Units of normal loss of material will be reduced and the cost will then be considered for the remaining units. We'll do the practical problem on it also. Abnormal loss, charged to costing P&L account. Right? Duties on which ITC is available are not to be added. So this is about the computation of purchase price. I hope every one of you have written this. This is the note that you have to write. Clear? Shall we move on to the practical part now? Okay, sir. Let's see. Question number 12. An invoice in respect of consignment of chemicals A and B provides the following information. Chemical A 10,000 kg at the rate of 10 per kg, 1 lakh rupees. Chemical B 8,000 kg at 13 per kg, 1 lakh 4,000. Basic customs duty at the rate of 10%. Credit is not allowed. See, they have specifically mentioned that credit is not allowed. 20,400. Railway freight. What is railway freight? 3840. Total cost is 2,28,240. A shortage of 500 kg in chemical A and 320 kg in chemical B is noticed due to normal breakages. So that means this is what? This is your normal loss. Clear? You are required to determine the rate per kg of each chemical, assuming a provision of 2% for further deterioration. You have to make a provision for further 2% deterioration. This is one breakage, 500 kg and 320 kg. This is the normal breakage, and after this normal breakage, you have to make a provision for 2%. This is again a part of a normal loss only. Right? Why are we making the provision, sir? Because we are expecting this loss to happen. Right? If you are expecting this loss to happen, it is from the past records, right? It is not because of any uncertain event. So if you are expecting this, that means it generally happens. It is a normal loss for you. Clear? So you are required rate per kg. So first we have to identify what is the effective quantity that will reach our factory. The invoice says we have sent 10,000 kg and 8,000 kg, but in our factory what will reach? We will record the cost for the number of units that will be reaching inside our factory, right? 10,000 and 8,000 units will not be reaching in our factory, sir. So we have to record what is going to reach in our factory. Question number 12, right? So first thing that we are going to calculate is calculation of effective quantity. Calculation of effective quantity. Right, sir. So we have chemical A, and we have chemical B, right? What is the quantity purchased? What is quantity purchased? Sir, as per the invoice, quantity purchased is 10,000 and 8,000 kg, isn't it? Now, less, normal breakages. Normal. It is given as notice due to normal breakages. So we'll take normal breakages. That is 500 and 320. So what is the quantity left? What is the quantity left after this is 9500 and 7680, right? Out of this, what you have to do is, he says create further provision of 2%. Provision for deterioration. Provision for deterioration, right? 2%. So we have to create a provision of 2% on this, that is 190 and 153.6. So what is the effective quantity, sir? What is quantity available? This becomes my effective quantity available. That means this quantity is expected to reach my factory 9310 and 7526.4. Clear? Now we have to find out the cost per kg. All this is in kg. This is total kg that will come. We have to find out the cost per kg. So second, computation of cost per kg. Computation of cost per kg. So again we have chemical A. We have chemical A and we have chemical B. Right, sir. So what is the invoice value? What is the purchase price, sir? Purchase price is given to you as 1 lakh and 1,04,000. What is the purchase price? Purchase price. It is 1 lakh and 1,04,000, right? What else do we have? We have the basic customs duty, and because the input tax credit is not allowed for this customs duty, that means it will form the part of my cost. It is 10%. 10% of what? Sir, obviously the purchase price, right? So add basic customs duty. Basic customs duty, right? 10%. So this becomes 10,000 and this is 10,400. That means total of 20,400 that is given to us, right? Now the railway freight of 3840. Now sir, it is given as combined for chemical A and B. How can we divide this railway freight of 3840, sir? On what basis? We will have to separate it between chemical A and chemical B. On what basis we can do this? Take a simple example, sir. When you go to courier something, right? Your friend says, please courier me that book. Okay, you say, I'll courier you the book. So when you go to the courier shop to courier that book, on what basis they charge you the amount? Sir, on the basis of the weight. They will weight your parcel, right? On the basis of the quantity that I can say, right? On the basis of the weight, they will charge you the amount. If your weight is 1 kg, they will charge you 100 rupees. If it is 1.5 kg, they will charge you 150 rupees, like this. This is how the courier decide the rates, right? So this railway freight is what? This is also for carrying the material. Freight means what? The courier company is also charging the freight, courier freight, right? So this railway freight will be distributed on the basis of quantity, that is 10,000 is to 8,000, or I can say 5 is to 4. Clear? Right, sir. Add railway freight. So this railway freight will be distributed in the ratio of quantity, that is 5 is to 4. This comes to 2133 and 1707. Just check once, sir, if it is the total is how much? Total is 3840. So 3840 divided by 9 multiplied by 5. Yes, 2133 and 1707. Total is correct, 1707. Yes, sir, 3840. It is correct. Okay. So what is the total cost? What we get is the total cost from here. Total cost is 1,12,133, and here it is 1,16,107. What we need is the rate per kg, right? So we'll divide it by the effective quantity. Divided by the effective quantity that we calculated in the first part, that is 9,310 kg and 7,526.4 kg. Then what you will be getting is rate per kg. Rate per kg is 12.04 and 15.43, right? So this was the requirement of the question. Now, just listen to it carefully. I told you here that normal loss will be reduced and the cost will be inflated for the rest. Here, the normal loss, what we did with the normal loss, sir, we reduced the normal loss, and whatever the total cost was, we absorbed on the remaining units. Clear? This increased the cost per unit. Why? Because the number of units declined. Clear? So, sir, in case there is an abnormal loss, then what we have to do it? Sir, the units of abnormal loss will not be reduced from the quantity purchased, right? Whatever the amount of abnormal losses, that will be charged to the costing profit and loss account directly. That will directly impact your profit, right? So it is to be charged directly to the profit and loss account. No impact will be done here. Clear? In the whole costing, just remember one thing: whenever there is an abnormal loss, the abnormal loss will always be charged to costing profit and loss account. This is a rule for the whole costing. Sorry, not for this chapter only. Clear? This is the rule for whole of the costing. Moving on to the next question. Question number 12 is done. Let's come to question number 13. At what price per unit would part number 32 be entered in the store's ledger if the following invoice was received from the seller? 200 units at the rate of rupees 5, 1000 less 20% trade discount 200, net price 800, add IGST 12% 96, add packing charges of 50 rupees. And further it says a 2% cash discount will be given if the payment is made within 30 days. IGST is available as input credit. Right? I told you 2 points here. Number 1, cash discount will not be taken. It is a purely financial decision. It is a purely financial decision, so it will not be considered. Let's see. Question number 13. Right? So, how we are going to record it in the books, this is what we have to see. Computation of cost per unit. Computation of cost per unit. Right? What is the purchase price? What is the purchase price? Sir, 1000 rupees minus the trade discount. So my net purchase price is, this becomes my net purchase price, isn't it? Sir, trade discount we have to consider. Yes, trade discount we have to consider. See it here. I've given it invoice or the list price less trade discount. Right? So I can write it as net purchase price. Net purchase price is 1000 minus 200, 800 rupees, right? Sir, after this, I will add IGST of 96 rupees. Will I take the IGST of 96 rupees, sir? Will I take the IGST of 96 rupees? Tell me. IGST of 96 rupees? No, sir. Why? Because it is given in the point number B here that IGST is available as input credit. That means if we are paying 96 to the supplier, we'll be taking 96 rupees from the government back into our pocket. So in one pocket it is flowing out of the pocket, on the other hand it is coming into the pocket, so the net effect will be 0. So IGST will not be taken. So packing charges, yes sir, 50 rupees packing charges will take. Add packing charges of 50 rupees. So the total cost here is, total cost here is 850, right? We'll divide it by the number of units, divide by number of units, that is 200. Sir, where it is given 200? See, this is 200 units, right? So what is the cost per unit? So what we'll get is cost per unit, right? This is 4.25. And what you have to do in the examination in such cases is you have to give a note here, notes, right? You will write one here, cash discount will not be considered as it is a purely financial decision, right? Cash discount will not be considered, as it is a purely financial decision. It is a purely financial charge, right? Second point you have to write, IGST will not be considered, IGST will not be considered as input tax credit is available, considered as input tax credit, as input credit is available. Clear? This much is clear, sir. So this is how you have to solve question. Now in the handbooks, in the question book, you will find some very good questions on this. I have put on some very good questions on this purchase price valuation. Just follow these rules, whatever I have told you, just follow this format, just remember these important points. You will be able to solve each and every question, right? So you have to practice from there now. Okay, so this is your homework now, that you have to revise this topic for this lecture. You have to revise the topic and you have to practice the question from our handbooks. Clear? Some very good questions are given in the handbook, so you have to practice from there. In case there is a problem, you can write an email to me. Okay. Right, sir. So we are done with this topic, that is purchase price valuation. In the next lecture, we have a small topic, that is inventory turnover ratio. This is our target for the next lecture. Next lecture is inventory turnover ratio, right? And regarding the questions, we have done till question number 14, that is JIT. We did it in the last lecture, and we are done with just 4 questions now. 15, 16 is for the ITR, then 17, 18 for the valuation of closing stock, right? With this, our chapter will be complete. That means we are left with the 2 topics now in this chapter. One is inventory turnover ratio, and the second one is the valuation of closing stock of raw material, right? So we are done with we are left with the 2 topics now, which we will be covering in the next 2 to 3 lectures easily. Right? So see you guys in the next lecture. Till then, stay safe, stay healthy. Thank you so much.